All right, welcome back everybody, and thank you to our sponsor break, LACDB. All right, on to session 3, What Do the Lenders Say? It's sponsored by CoStar, the largest source of verified commercial real estate information, analytics, and data-driven news worldwide.
CoStar's market and submarket reports give you reliable, connected insight in minutes. With 15,000 market and submarket reports covering all asset types, you can get up-to-date commentary from our expert analysts and economists. Quickly view key performance indicators including vacancy, absorption, construction activity, rental rates, and economic and demographic information. Get the intelligence you need to understand what's happening in the market. Get CoStar.
And now, ladies and gentlemen, please welcome to session 3, the panelists Drew Remson from First Horizon Bank, Thomas Ogg from Gulf Coast Bank and Trust Company, Percy Manson from Hope Federal Credit Union, Richard Ziegler from Bonvenu Bank, and your moderator, Mr. Bob Bergeron from Crescent Title.
Good morning, everyone. I'm Bob Bergeron with Crescent Title, and we're going to be moderating this panel of lenders. Today, we're going to dive into the pulse of the local lending environment, how banks are navigating credit conditions, evaluating risk, and how they're advising borrowers in this shifting market. Our panelists represent a cross-section of institutional lenders active in the New Orleans market, and they'll be sharing their insights on how to better navigate for agents, for investors, and developers alike. So let's get started. And Richard, you want to introduce yourself?
Sure. My name is Richard Ziegler. I have been a commercial banker for about 20 plus years now, primarily at large institutions, and I currently working for about 2 years at a bank based down of Bossier, Shreveport. It's a bank, actually it's turning 40 this year. We went through a rebrand about a year and a half ago. It used to call Citizens National Bank, currently called Bonvenu Bank, and we've been in Southeast Louisiana now for about 4 years. The bank is about $1.5 billion in assets, and primarily very much a commercially focused bank.
Thanks. Percy?
Percy Manson. Test. There we go. Percy Manson. Been in banking for 30-something years now. I'm with Hope Federal Credit Union. I am Senior VP, Director of Sales for Hope. So basically, commercial, small business in our 6 footprint reports to me, which is Louisiana, Arkansas, Tennessee, Alabama, Mississippi, and now Georgia. Hope is a CDFI, so we do very large deals from hospitals to community centers to affordable housing, LIHTC deals, and just regular commercial deals that other institutions would do as well. So excited to be here today. Thank you.
Thomas?
Thomas Ogg with Gulf Coast Bank and Trust. Gulf Coast Bank has been around since 1990. We are the largest locally owned bank in Louisiana. I've been with the bank for the last 20 years in commercial lending, and happy to be here. Thanks.
Good morning, everybody. I'm Drew Remson. I am a residential mortgage lender with First Horizon Bank. I've been with the bank for approximately 6 months. Prior to that, I was an independent mortgage banker for the last 29 years as an owner of America's Mortgage Resource. I also have 35 years of personal background in the investor side, both as a developer, an owner, an operator, and construction background. Happy to be here. Thank you.
All right, well, let's start with a question. How are banks evaluating different asset classes today, such as owner-occupied versus investment properties, and have preferences shifted in the last couple of years? Richard, you want to start?
As I mentioned in my introduction, my previous history has been about 20 years with large banks, and I can speak to that real briefly, that we really didn't touch investment real estate. The reason being is Typically, we looked at when there's stress in the credit, typically an investment real estate deal would be maybe the first to be defaulted on as opposed to owner-occupied. Now working for a community bank where we focus heavily on Louisiana, we evaluate real estate as real estate regardless of how it's classified, whether it's income producer and owner-occupied, and of course we underwrite the guarantor's strength. So with a community bank, there's not much differentiation between owner-occupied investment real estate. But I think all four of us will echo, I think the bank is always looking for owner-occupied. The default risk is lower, not to mention you're more inclined to build a relationship around owner-occupied as opposed to developers just wanting one-off pieces, credit facilities at different institutions.
And I'll say something in reference to the credit union side. We also, and I ditto everything that Richard has said, we also look at the same. So if it's real estate, investors, we deal a lot with developers and those that are doing communities and things like that. So we want to be able to fund those deals. We want to be able to be in the communities, not just to fund the deals, but do more community-based things as well. So we are a community-based federal credit union as well. Hope was started in Jackson, Mississippi, and now has branched to these other states. But real estate is a lot of what we do. So any clients or realtors, I get calls all the time about certain deals, but there's nothing we would not entertain. So I really want to throw that out there. So if there's a deal that you think it may be risky, because we do have a nonprofit side to the credit union as well, because we are CDFI, so we're able to look at things in a different perspective. So we definitely would look at those type of owner-occupied and real estate deals.
Yeah, for Gulf Coast, if the deal makes sense, we're going to do it. Owner-occupied, investment property, whatever it is, whatever type of property. If the numbers work, good guarantors, it's going to be a deal we're going to work with.
Yeah, same thing with First Horizon. On the commercial side, banks don't like risk. Owner-occupied properties have less risk, so of course all of us are looking for owner-occupied deals. At First Horizon, we typically have some premium products for the owner-occupied side. And just to kind of tell you the differential on owner-occupied versus non-owner-occupied, for us as a larger institution, or the larger of the group here at a $88 billion bank, we look at the owner-occupied very differently. We'll go 90% loan-to-value on an owner-occupied deal in most classes of business. We'll go to 100% for our folks in the medical community on commercial, which is almost unheard of. We stretch our terms out to 25 years on owner-occupied. We'll do a 20-year fixed versus a 5 to 7 year fixed, which is typical in the commercial market. Pricing's generally a little better on the owner-occupied side as well. So we like both, we pursue both, but there are some incentives available on the owner-occupied side.
Drew, let me follow up with a question. What spreads are you seeing over treasuries on typical commercial loans, and how have these changed in response to Fed policy and inflation pressures?
So Bob, on the treasuries have been sitting, in the 4.3 range. We kind of expect those to stay there through the next year. I think all of our margins, both on the commercial and residential side, have been squeezed over the last few years. There's less transactions going on because of the locked-in effect since COVID. People are locked into low interest rates. So I think the margins have been pushed down across the board. On the residential side, I think they're as low as I've seen in my 30-year career. And I don't see that lightening up at any point in the near future. On the residential side, what we're also seeing that adds to that is that locked-in effect, people aren't moving up like they typically do every 5 to 7 years, which is the national average over time. People are adding square footage to their properties, they're putting in a pool, they're making their kitchen nicer, and they're keeping their 2.875 rate, which puts a lot of pressure on the market for all of us. So that's squeezing margins as well.
Anyone else?
usually still work with Wall Street Journal Prime on our end. You know, we're going to be prime plus something depending upon the deal, or at prime for an A-rated customer typically.
Yeah, we price off of prime or some variation of SOFR, and typically we try to keep margins, meeting some sort of internal rate of return, in rising or decreasing interest rates. So we try to keep that margin the same regardless of where SOFR or prime happens to be, or treasuries.
So in other words, we're passing on the changes in the market to the client. Margins pretty much stay the same on the commercial side.
Correct.
Residential side, we tend to get squeezed a bit more.
Percy, we have some appraisers in the audience, and so I'm going to ask you, are appraisals keeping in pace with seller expectations and buyer capacity in today's interest rate environment? And where are the biggest disconnects?
Great question. And of course, we all work with appraisers on a regular basis, so we love them just as much as they love us. So it gets, for us, sometimes we have some tricky things going on with appraisals. So we have to go back to the drawing board, and if the appraisal does not come back as the client anticipate, then that's always an issue. And even when I was at Gulf Coast, kind of the same thing. We would go back and forth, and it still exists today with the appraisers, with what their value is, and if it's a walk-in value, or if it's just a drive-by, or we're just getting it from the internet. At the end of the day, it is the client usually, and the realtor sees this a lot too, because the client is talking to us as the banker and the lender, and the client's talking to the realtor. So we're in between them and the appraiser, and we're trying to fix the whole thing, right? So imagine that with all those types of attitudes and things going on between the 3 or 4 of us. But at the end of the day, we really do work it out with the appraisers. And I think the values right now, it depends on the market as well. So the market plays a big part in that, and everything that's going on in DC will play a part in that as well. So I think values are what they are. We have to use them. We can't get around them. And so at the end of the day, we have to work with the appraisals.
I haven't seen too many issues with purchases. It seems like most deals are working the way the contracts are written. However, on refinances, that's where I see some maybe unrealistic expectations from the borrower, where they're still thinking we're at peak prices, post-COVID, where in reality prices have come down a little bit since then. Prices aren't falling dramatically, and they're stable right now, but that expectation level is still a little bit higher for those borrowers on the refinances. So they're seeing some values maybe not as high as they would like.
And it's an educational piece for the borrower. So at the end of the day, we're actually educating them on our process and with what's happening with the appraisers as well. So getting them to understand that process could be the challenge sometimes.
Yeah, and on the residential side, we're not having a whole lot of problems locally here in New Orleans. Most of our neighborhoods have held pretty steady. Prices are actually up slightly for Greater New Orleans across the board. Certain neighborhoods have fallen, like French Quarter specifically. But what we're seeing is that buyers and sellers are more in line than they were a year ago. There is not that disconnect between buyer and seller, so contracts are being written very reasonably on the front end, and we're just not seeing appraisal issues.
And good real estate agents will prep their sellers to a property's only going to sell for what it's worth for the most part, and the market will govern that. So let me jump to the next one. What's the practical guidance that each of you are giving borrowers on how to position themselves for successful financing in this lending environment? And maybe we'll start with Thomas.
Sure. So I've actually got this broken down to a couple of different categories. So for all borrowers in general, no matter what kind you are, number one, improve liquidity buffers. Banks want to see cash reserves, ideally 6 to 12 months of debt service coverage in liquid accounts. Number two, clean up your credit. If there's any sort of credit issues, make sure you correct those errors. Be ready to discuss any credit blemishes that are out there, and then pay down any revolving debt. Number three, make sure you document everything. tax returns, financial statements, rent rolls, leases, and property management records, making sure to keep them organized and up to date. You wouldn't believe how often I deal with a customer and their paperwork is just a mess, and usually that's a bad sign when you're presenting to a bank and your paperwork isn't in order. That's something super easy to do that most people aren't prepared to do, and that really gets you ahead of the game when you're applying for a loan. For business or owner-occupied borrowers, number one, emphasize stable business performance, diversified revenue sources, and recurring customers. Have those listed out. Number two, prepare updated financials, forecasts showing ability to sustain higher debt service under stressed assumptions. The next category would be for investors. Number one, demonstrate conservative leverage and a clear capital stack of where your cash is coming from. Number two, highlight strong tenant quality, document those long-term leases, and show that you've got a low vacancy risk. Number three, show you can support the asset even during temporary cash flow dips. That's a really big thing that banks are looking for these days is, what if your project's not working, right? Okay, how are you gonna make up that gap in that tough time? In general, just think like a bank. De-risk the deal as best you can. Banks want to see that you've already done the risk management for them up front. The more you can demonstrate that, the more the bank's going to believe in that deal as well. So number one, underwrite your own project, include a debt service coverage ratio, break-even occupancy, and some sensitivity analysis. For example, if rents go down, I can still meet my debt coverage if they go down by X amount. That's always a good thing to take a look at. Number two, reduce leverage if possible, bring more equity to the deal. Number three, show some contingency planning. Lenders appreciate borrowers who can articulate what if rates stay higher, vacancies rise, just all the different pitfalls that are out there. The more you can speak to that, the better that deal's gonna look when presenting it to a bank.
And I'll just add, we as bankers and institutions, if you're working with a CPA, look, you don't even have to know all of that stuff that Thomas just listed, right? So your CPA is going to be able to transfer all that information over to the bank. We love CPAs, so we know that when you're working with a CPA, that your financials are correct and everything is in order. So if you allow us to speak directly to the CPA, we can get all that information, take you out of the loop of it. We can actually work faster and more effectively once we're dealing directly with your CPA. So if you're not working with a CPA, my suggestion to you is, find you a good CPA. We can recommend some to you, and start working with the CPA so that your financials are in order. And Thomas did mention the credit. That's a big piece of it. A lot of what we do at the credit union, because a lot of our clients don't have the credit. So we have a lot of TA providers who help get them there, right? Not just with the credit piece of it, but even with their financials. So even across our footprint, we are working with our clients every single day. We're hand-holding them pretty much. Look, this is what you got to do to get there so that you can be bankable in the future. So definitely work with the CPA, make sure your credit's straight, and I think you'll see some good results.
So on the residential side, you're typically dealing with a slightly less sophisticated individual than you are when you're doing commercial banking. So my advice is always, before you put them in your car, you drive them around for 6 months, get them to a mortgage banker you trust, get a pre-approval, not a pre-qualification, huge difference. Make sure that your client has realistic expectations on what their buying power is, both in a monthly note and what it takes to get to the closing. People are shocked at what insurance and taxes cost, and their perception of what they can and can't buy after they talk to a mortgage banker may change pretty drastically. The other part of the equation is, in today's environment, we have the internet, and our clients are going to the internet first, and they're getting a very limited picture of what's available. Banks have a whole lot more in their toolbox than Fannie Mae, Freddie Mac, FHA. We all have portfolio products. We've got DSCR products, bank statements, things that they're not going to find if they're doing a generic search on the internet. So you may lose a client that's very bankable but doesn't know it if you don't send them to someone who knows what they're doing in the space.
two quick things out on the commercial side. You know, when we request all the financials and we get a credit score, so the financials, what we're trying to determine is the capacity to pay not only existing debt, but whatever the proposed debt is. Your credit score will show your willingness to pay that. So that's great, you make $1 million, but if you have, you know, debt service well in excess of what your income is, you're kind of upside down. Or worst case, you just don't pay your bills. So we try to evaluate the capacity and the willingness. And then, you know, if you just keep in mind, I don't have much to add what Thomas added, but, you know, if you're coming to the bank on a commercial deal and it's, you know, you're looking for lending 80%, you know, whatever that amount is, 75%, 70%, depending on what the loan to cost, loan to value is, just put yourself in the bank's position. If someone's coming to you to ask for 75%, 70%, and you're putting in whatever the difference is, you want to be able to, if someone was coming to you, you would want that person to be prepared with up-to-date financials, complete financials, being able to answer your questions. So the bank is looking for the same thing from you. So if you just put yourself in that situation, I think you'll be much more prepared as to what the bank is expecting. You know, you both are going to have skin in the game. Your percentage is going to be a lot less than the bank's, so just keep that in mind. But once you get into a credit facility together, you know, it is a partnership, it's a relationship.
Thanks. So since yesterday, October 15th, no longer can we use the excuse that we haven't done our tax returns. Oh, we shouldn't. We shouldn't. But I'm going to pivot a little bit, and in our shop, we're seeing more. You know, June 2022 was when interest rates started to go up and the market shifted dramatically. And over the last 3 to 6 months, we've seen some changes. We've seen more 1031 exchanges. We've seen continued seller financing or sellers assisting in that. But the question is, from a, you know, what are you seeing? Creative deal structures, blend and extend, delayed draws, anything used more frequently? Anything else you're seeing in your market?
I'm not really seeing anything that creative on our end on the commercial side, and I don't do much in the residential side, so.
We're really keeping it to the basics. I mean, we don't get anything too crazy out there, but I would say the most creative we get is you come to us and you maybe don't have a down payment, but you've got another piece of property with a lot of equity in it or no mortgage on it. We'll take that additional piece of collateral to help you get that deal done, where you don't have to put any cash into the deal. Or you have a stock account that's a non-retirement account, but you don't want to liquidate any of those stocks for capital gain purposes. We'll take some stocks as additional collateral for a deal. So that's about as creative as we'll get on our end, but that does serve a good amount of people that maybe don't have that equity piece of cash.
On the residential side, there has been a few products that are becoming more mainstream in today's environment, specifically the DSCR product, which is a no tax return, no income verification for your investors. It's a great product, especially in the environment where banks are tightening up on small residential type deals. This product allows you to get in without tax returns, looking at just the DSCR. Also, bank statements for self-employed. Those are great for your individuals who are self-employed, have really good CPAs who've done their job, written down the income, but you have a very stable buyer with good credit scores and can show a lot of money coming into their accounts. They just can't show it on their tax returns. So those are probably the two largest creative pieces in the residential side right now.
Thanks. None of us can predict what interest rates are going to do. Or some people do, and I hear them all the time, but nobody's been right so far that I hang out with. But from a banking perspective, and we heard the first speaker talk about the new tax bill, which creates some opportunities. But from a banking perspective, what risk or opportunities should brokers and developers be preparing for over the next 12 months? Thomas, you want to draw that one?
Sure. So even though rates have really come down from their peak over the last year or so, we're still a lot higher rate environment than we were, say, you know, during COVID and post-COVID. So you still have a lot of loans out there that are priced at, say, 2.75, 3.25%, and those are still coming up for adjustment, whether it's 3 months from now, 12 months from now, and even 18 months from now. And while rates have come down, you got Wall Street Journal Prime as of today is at 7.25%. The Fed's expected to lower that rate hopefully one or two more times in the next couple of months. You're still going to be looking at folks that are going to be, doubling their interest rate from where they currently are. Anything in the sixes is really a great rate historically, but that's really high compared to where they were, 2 years ago, 3 years ago, 4 years ago. So there's still going to be some issues with some deals out there that aren't going to cash flow as well. Obviously, you have higher insurance costs. You've got higher operating costs, labor costs to get repairs done. All those things are going to crunch cash flows. So these owners need to be prepared. Hopefully they've saved up some reserves to take care of any of those issues. Hopefully rents have increased. If they're not getting those increased rents, then they might be looking to sell and hopefully selling at a reasonable price to make the deal work for the next person.
And I'll add, continue to pay attention to, the cost of your labor. Make sure that you're paying attention to what it's costing you to build that project and the lumber on it and things like that. So, just be attentive and attuned to what's going on in your market. And I think each market could be a little different, but at the end of the day, I totally agree with Thomas. We haven't really seen much of a difference there, but I would say to the developers, just pay attention to your market, pay attention to what's going on and understand what it's going to cost you to get that job done and make sure you relate that to your client.
Percy, I'm going to stick with you. A real estate agent calls and says, have I got a deal for you? What do you say?
Look, I love realtors. I do. And I get these calls all the time. But, I would tell my realtor at the end of the day, that's your client and it's my client too. So we're on the same path here, right? So we're trying to accomplish the same thing. We're trying to get our client to the finish line. And we all want to reach that goal. So I love having realtors call me. Matter of fact, I actually do some kind of realtor forums or different type of happy hours. They like to happy hour things. So to bring them together just to actually, let them know that we are an institution that want to work with them. And a lot of my deals have come from realtors. When I was even in the banking world outside of the credit union, it still continues to come. So, my suggestion to the realtors is just, look, we're trying to get to the finish line. I know you're calling us all the time. Your client's calling you. It's the end of the month. You're trying to get the deal done. We want to get it done too. So, thank you.
I would say when I get those sort of calls, I want to see some prepared financials. Why is that deal so good? Do you have the pro formas ready on what that project is looking like? What's going on with the physical asset? What's making it such a great deal? Is it a distressed seller? Is it a property that's listed below market that no one else is seeing? Is it an opportunity for a redevelopment where you can get a tenant in there and boost the rent that was previously on the project? So just some of those factors of why it's making it such a great deal and why is it something that's going to be so great for the client.
Over the last few years, we've heard that banks have had some emphasis on deposits, and sometimes even you've heard over loans. Anybody be able to comment on that? Is that true? Is it exaggerated, or where are we going?
Well, commercial banking is pretty simple. You take in deposits, you pay X rate, and you try to lend those dollars out at a higher rate and make the spread. You're assessing risk, and you have to worry about charge-offs, et cetera. So the lower the cost of those deposits, typically, the better it is for banks. So yeah, there's been a big emphasis on gathering deposits, at least at my institution. I'm sure at your institutions, a little less so as rates are coming down. And that's another reason why we like operating credits, owner-occupied real estate. And just so owner-occupied is, it can be met in one of two ways. Over 51%, just physical, a company occupying over 51% of the space outside of common areas, or if that's primarily the biggest one, or if the cash flow from the third-party entities is not enough to sustain the cash flow, so sustain the debt service of the building. So those are the two criteria for owner-occupied investment real estate. So we like owner-occupied because typically those deposits will come in the form of an operating account where we pay 0 interest. So obviously the spread's a lot better when you pay 0 and you're lending at 6 and 7%. Typically with investment real estate, those are more deposits that are parked at a bank where they're interest-bearing, more market rates, you know, you're 3 to 4%. So we still have a big emphasis on gathering deposits. You know, if you don't use your own deposits to fund your credit portfolio, then you have to go to outside sources, whether that's in the community bank, whether that's a correspondent bank, whether that's the Fed window, you know, whatever the funding source would be. So what the cheapest is to pay depositors a cheap interest rate and lend it out at a higher rate and make that consistent margin. So I think there'll always be an emphasis on low-cost deposits for banks.
It's banking 101. I mean, we love deposits, we hate risk. So yeah, deposits are going to be important in any environment, not just this one, but so is lending. So we try to balance the two between the amount of deposits we're looking for versus what we can lend out and not have to use the higher cost funds, as you mentioned. On the residential side, we're kind of at an advantage because even if we hold and retain our servicing, which we do, we get fresh capital by selling off our loans and retaining the servicing. So we can increase our production without eroding our capital. So we're always pushing for more production on the residential side, regardless of the capital.
Yeah, and most of us are relationship banks, so we're going to want your relationship. So even when we're looking at your deal and we're looking at lending you money, we're going to look at your relationship to see what you have on deposit with us as well. So I think all of us are going to be looking at deposits in the same way. And I don't think that has changed, as Drew has said, over the years. So we're always going to be focusing on that relationship.
All right. I heard owner-occupied property is your preferred product. What else? You're 4 different lending institutions. What else do you like to lend on? What's something that your sweet spot, so to speak?
Well, for us, a majority of my loans are investment real estate. We love owner-occupied, of course, but that is not the majority of what I personally do and what I see a lot at the Gulf Coast Bank. You know, so again, if it's a apartment complex, if it's a development deal for some single-family houses that are going to be sold, land deals, apartment complexes, strip centers, you know, all those kinds of deals, you know, we love deals that cash flow, and if the numbers make sense, right? And even if the numbers maybe don't make sense and the deal's a little skinny, we're still going to look at the deal and the whole relationship with the customer. So if that customer brings a strong personal guarantee to the deal and the numbers might be a little weak from our underwriting standpoint versus the customer's, you know, numbers that they have written down, then we're still going to do that deal if that's a strong guarantor out there. And if it's a non-real estate deal, we still have solutions for that at Gulf Coast Bank. We're more of a financial services company than just a commercial bank. We have a factoring division that helps out accounts receivable companies that need that sort of funding. We have a equipment leasing type company that is outside of the bank. We also have an SBA lending group. So you bring in somebody that maybe needs a smaller down payment, or no down payment. In fact, there's a possibility for that on the SBA side. So we've got a lot of solutions for folks that are, you know, my bread and butter would be the investment real estate, but anything outside of that, we're still able to accommodate customers for any type of loan request.
Yeah, and I would say investment real estate is a large of what I do as well. But we're CDFI, so we do a lot of LIHTC deals. We do a lot of charter school deals. You know, we fund a lot of new market tax credit deals. So I think we have a wide gambit of deals that we actually would look at. But the thing about HOPE is that we're going into communities that most institutions won't go into. We're going into the underserved communities. So we're actually holding their hands and teaching them banking, not even 101. like probably 005 something, right? So we're actually teaching them what does it mean to be bankable? What does it mean to be, to have a checking account and to operate it and how to balance it? So even before you get to the lending piece of it, we're actually training and teaching people what it means and what institutions are looking for. So we're in those communities, and it makes us a little different and a little unique because, again, as I said earlier, we're holding their hands, but at the end of the day, there's no project that we would not entertain. I mean, we've never done some things I've seen at Gulf Coast. I've seen we financed an airplane and things like that. We've never done that before, right? But will we entertain it? Absolutely. If it cash flows, it makes sense, as Thomas said, we would entertain it.
Yeah, we like getting good guarantors, good borrowers, good households, and then whatever project they come with, we'll evaluate it at that time. At a community bank, it's much different than national banks. We view it like Gulf Coast Bank. Real estate is real estate. Does it cash flow? Whether it's owner occupied, does it cash flow from the owner's business? If it's completely investment real estate, does it cash flow from the leases, et cetera? So. But having the guarantor behind it is very, very important, and that comes with liquidity, outside cash flow. If a project, leases get terminated, building burns down, cash is king. Having that strong guarantor, so that is having the strong guarantors is very, very important, and then the project is almost secondary.
So on the residential side, we have slightly different perspective. 80% of the market is going to be agency, secondary market transaction type business. We love that because it doesn't erode capital, which we discussed already. But we're an $88 billion bank, so we do a fair amount of portfolio lending, even on the residential side. So to put that in perspective, our budget for residential portfolio loans for 2025 was $1.2 billion, and that's just residential, no commercial in that mix. We spent that entire budget this year, and then some. We expect it to be a little larger. So on the residential portfolio side, our premier product is our physician's loan, 100% financing. We do a ton of that, and we are one of the premier players nationwide in the physician space. We do a lot of high net worth, self-employed borrowers that don't fit into traditional mortgage products, a lot of in-house jumbo business. And then at the other end of the scale, we're doing a lot of first-time homebuyer stuff, along with grants and other incentives from the bank to get first-time homebuyers in our community redevelopment areas as well.
As lenders, you're always assessing risk. Conceptually, how do you assess a single-tenant property on a triple net lease versus a multi-tenant property with some acceptable vacancy? Thomas, you want to?
Sure. So both deals, whether it's a single-tenant property or a multi-tenant property, they both have their pros and cons, right? So single-tenant property, it's all based on that one tenant. How strong is their credit? Are you dealing with a Bed Bath & Beyond that went out of business a couple of years ago, or are you dealing with a Publix or a Chick-fil-A, right? So, there are certain single tenants that are more desirable than others. The stronger the tenant, the more the bank's going to love it, and the more it's going to make sense to do that deal for the bank. Versus a multi-tenant property where there's going to be more complexity there, having to deal with multiple tenants. But now if you have a 10-unit strip center and you have one unit that goes vacant, that's only 10% of the deal. We underwrite with 5 to 10% vacancies on our deals anyway. So it gives you more flexibility on those multi-tenant deals. So we love to look at both deals, and each deal is their own, right? So again, pros and cons to both, but the bottom line is with the single tenant property, how strong is that tenant? And with the multi-tenant property, you're going to have more flexibility there with tenants if one goes bad.
To piggyback on what you said, our office is on Maple Street in the University area, and Starbucks shut down last month, and PJ's shut down 6 months ago. So I guess you never know who's out there, what's going on. So if anybody represents a coffee shop, there is a void on Maple Street. Percy, do you have a required debt service factor on income investment property? Because you are lending on it.
Yes, yes. So we will lend, it depends on the situation, depends on the client. We talked about deposits, depends on what they have relationship with us. We'll lend 80%. We can even sometimes go to 75%, just depends on what's going on, loan to value with the issue, so, and the relationship. So we want to be able to lend and make sure that we are meeting the requirements of not just the regs of the credit union side of it, but also making sure that the customer is comfortable and the customer has their cash injection and those things to make the deal smooth. So yeah, so I would say, 75, 80% loan to value.
Yeah, I would say, an owner-occupied deal is typically, bank lends 80, you put in a cash injection of 20%, whether that's cash or, marketable securities or whatever it may be. Investments, depending on the property type, if you have a car wash or a single-use facility, the bank was always looking, not so much going into the deal, but if the deal goes sideways, how do you get out of it? Selling a car wash is a little difficult. You can only really sell to a car wash. So, you may not, maybe the bank lends 60%, you put up 40%. Hotels are typically another, banks will lend 60, 65%. So depending on how strong the asset class is depending how much the bank will lend against it. But typically we're looking for at least a 10% cash injection. This is outside of the SBA conversation, of course, strictly just traditional bank lending. But that'll give you an indication of how risky the bank assesses that underlying piece of real estate.
Drew, I think you said you were lending at 2 7/8 right now. Is that...
Of course. Only for you, Bob. Only for you.
But here's my question. I'll tee this up. If you had a voice, if you had a chance to talk to the Fed chairman, any suggestions, any advice you'd give while maintaining our apolitical nature? This is not political, but what thoughts on that?
I'm trying to stay apolitical. I think the Fed's independence is extremely important. So just to stay independent of all branches, one in particular, and just follow what there's 2 mandates of the Fed, so as long as they follow that, I think we'll be in good hands. I think they've done a fantastic job up to this point, so more of the same.
Well, they've got a tough job ahead of them, is the bottom line. With inflation possibly going back up, with the tariffs, all that has still not been fully worked through the system yet. So it's kind of a question mark there. Where is that going to go? And then, unemployment, if that continues to tick up, they're going to be fighting 2 things that they're trying to control at the same time. I'm glad I'm not in their shoes.
Yeah, I think our CEO, Bill Bynum, matter of fact, he's here this week at Federal Reserve speaking, and really trying to make sure that they understand the communities that we serve. So we're in constant communications with them. Do we always get the results? Absolutely not. But at the end of the day, they are listening. So just not always the results we want.
Next question. Do you anticipate any more mergers or acquisitions? Are there any benefits or detriments to the consumer? Drew, you want to tackle that?
So, Bob, as you know, I'm coming off of a recent merger into First Horizon after 29 years as an independent mortgage banker. I personally think you're going to see a lot more of this across all lines, not just mortgage banking, commercial banking. On the real estate side, we're seeing it. Compass is gobbling up people. They're not alone. It's being driven by multiple facets. First and foremost is decompression of margins. What's driving that? We have the locked-in effect. People are moving less because they have low interest rates. But the cost of doing business is rising. It's rising across the board. Cost of labor is going up. But you also have the federal funds costs are going up for most of us. For small banks and mortgage bankers, the capital requirements have gone up every year since I entered the industry 29 years ago. So we have to tie up more money to make less. And at some point, you look at your investment and say, can I deploy my money elsewhere and make more money? And I think that's happening across the board for smaller players. And cost of technology continues to go up. Cost of regulation continues to go up. But the capital cost is really the death sentence for a lot of the smaller players. It just becomes too expensive to tie up that much capital. As far as effects on consumers, I'm not a huge proponent of massive behemoths in any industry. The further you get away from the customer with your decision-making process, generally the worse job you do with customer service. So the balance becomes, how do you grow your organization? How do you become bigger and more profitable by being able to do it more efficiently, but not lose the customer focus? It's a really difficult thing for banks, for real estate companies, for all of us to do, is to balance that customer relationship with size. Once you lose the customer relationship, everybody loses. So we really need to focus on that.
Yeah, and here at Hope, we've had some mergers also. So we've bought some credit unions that were suffering in the Birmingham market and also in the Atlanta market. So we just recently acquired a credit union in Atlanta. I think what's happening is, I think to Drew's point, the cost of doing business, and maintaining that, it's hurting. So if you're not receiving those loans and those deposits, I keep going back to that, but if you don't receive enough of those, eventually something's going to happen. You'll be off balance as an institution. So again, we're always looking for institutions or credit unions that are not performing, and a lot of those come actually from the Fed. They'll suggest to us, look, here's a credit union having some issues. Would you like to be in that market? So that we kind of work with them on that as well.
I would just recommend that as you move into those markets, that you keep as much of the decision-making and the focus at the local level. Because real estate is a very local business. It's not a national business. It's different in every market that we serve, especially for you. You're in underserved markets. You got to keep the decision-making and the focus at the local level.
We heard Michael Hecht earlier, and he always puts a bright side. I always feel better when I hear him talk. But what's the most dynamic aspect of our market? Thomas, you want to tackle that?
Well, the items I kind of jumped out to me aren't necessarily specifically real estate related, but you've got New Orleans increasingly positioning itself as a logistics hub, right? Big projects like the Louisiana International Terminal in St. Bernard Parish, those are boosting the capacity for import and exports, distribution and shipping. Also, there are major manufacturing energy-related developments in LNG, like Venture Global's project that I'm sure everyone's heard about by now, and it's still ongoing, and they're still building more and more facilities over there down in Plaquemines. That's bringing lots of capital investment and thousands of jobs. In healthcare, that's one of the fastest growing sectors in the New Orleans area. In the last 10 years, we're up about 16% in employment growth there, and that's contributing billions of dollars to the region. In digital media, there's been a big spike there with content creation, software, and gaming. I'm looking at a 51% increase in employment there in the last decade. Some other items I wanted to jump out, real estate related, that I thought were really exciting to see, and this is, again, Michael Hecht. He sends this email out every Sunday. If you're not on his email blast, I suggest you check it out. It's a really great positive note on something going on in the market regionally, and it's always a bright spot. And these are a couple of the things he and the Downtown Development District pointed out that everybody should be excited about. So you've got Delta Utilities, who recently expanded their headquarters at Plauche, St. Charles. That is now the largest Class A office transaction in the last 5 years. The redevelopment of the Charity Hospital, anchored by Tulane, continues. Once complete, the project will reactivate the long vacant building to a $600 million mixed-use life science and innovation campus. The project's going to include biomedical and public health research labs, academic classrooms, and up to 300 units, including 150 for middle-income households. You've got the old Whitney building at 210 St. Charles Avenue. That's still slated to become a boutique hotel. Over on 1000 Howard Avenue, the old Archdiocese property, that's being redeveloped into a 39-unit mixed-use apartment-style hotel. And then you've got the River District where, Shell is going to be opening its new offices over there next to the convention center. That project's got its foundation in place last time I saw it over there. And that's going to be a very exciting project for the area with a lot more to come over there. So there's a lot going on in the CBD and the New Orleans market right now. And those are a couple of the highlights that I saw from Michael Heck's email that I thought were worth mentioning.
I mean, conversely, anything, any disturbing aspects in the market that you see that you want to comment on? Percy, I think Drew mentioned loan resets.
Yeah, Bob, so the two biggest risks that I see in the commercial market for us in greater New Orleans right now, number one is population loss. It's hard to have a healthy real estate market if we continue to lose population both in New Orleans and Louisiana. That's been an ongoing problem for years for us. We've got to find a way to attract better jobs, and we've got to find a way to retain our children who are highly educated, who have great university opportunities here, but then leave the city as soon as they graduate. Secondly, the biggest risk I see is the fact that we're coming into the largest reset of commercial loans in history. All of your clients that bought or refinanced during COVID, they've got the really extremely low rates that we've all been talking about. They're looking at a situation where their insurance has doubled over the last couple of years. Now they're going to be faced with an interest rate doubling. We are at the beginning of that effect right now because most of those loans were done on 5 to 7 year balloons. So we're just starting to see them reset. We've got another couple of years to get through. They're facing large increases in their principal and interest, increases in their insurance, and increases in their operating cost. So what happens in that situation? Only one of two things can happen. Values fall to accommodate this situation, or rents have to rise. Can we raise our rents enough to offset those issues that we're seeing on the commercial side, or do we see it manifestate in loss of value? So those are the two areas that I'm most concerned with.
One of my concerns is economic development, making sure that we attract businesses to our city. I know our mayor-elect is going to focus in New Orleans East with that, and so I think that's a great opportunity for all of us in the room to think about that and how to grow economic development in New Orleans East. It's definitely a population that has been looked over, East and Ninth Ward, since Katrina. And I think it's about to be a big focus right now. And I think it's going to be a big boost in real estate there as well. It's kind of what I see. So economic development and attracting those businesses to come not just to New Orleans, but to the state of Louisiana.
So the two things I heard is if you're a real estate agent in New Orleans East in the Ninth Ward, and if you've got somebody who borrowed money 5 years ago, maybe it's time they want to consider selling their building. So make note of that, contact your people, stay in touch. I'm going to shift a little bit. When your mother-in-law sends you an email that starts with, "I hope this email finds you well," you know that she has found AI. And I want to throw out there, the first speaker talked about AI and really had some interesting insight on it. And what role is it playing at all in any of your banks or your lending institutions? Is AI perhaps in underwriting or risk assessment? Is it playing a role? Drew, you.
So on the residential side, I think we're way ahead of the commercial banking side with AI. It's affecting us on several facets. First, on the marketing and acquisition of clients, we're seeing more companies heavily rely on AI to bring in clientele on the front end. But to answer your question specifically, whether we're using it in risk analysis, we are. It's becoming more mainstream, and actually even Fannie Mae and Freddie Mac have automated systems that will upload the tax returns, read those tax returns, and spit out a decision on where the income is. For us as mortgage bankers, we retain the risk of the underwriting on that loan for 30 years. Fannie Mae and Freddie Mac have instituted what's called one-day certainty. If you run it through their system and you accept their income and you underwrite from their income, you actually can eliminate your reps and warrants for income for the life of that loan. It's a pretty big, huge step for independent mortgage bankers and banks as well, because we've got cradle-to-grave liability for underwriting. It's not a perfect situation, and I will tell you that brain power is more important than AI power when it comes to underwriting. But I think what you're going to see on the residential side is that within the next couple of years, all loans will be run through AI to calculate income on the front end. And then there are going to be two sets of banks or lending institutions. You're going to have your rocket mortgages that run it through AI, and if you don't like the decision, they're going to decline it. Then you're going to have banks that have expertise from underwriters that have been in the business for 20, 30 years that can find ways to massage that deal, rearrange it, and get it through a conventional loan.
Yeah, we are actually running a pilot right now for small business. So an opportunity, we're not there yet, but we're running a pilot, doing some testing to determine. So I think we're all going to be heading in that direction. We're just not completely there yet.
I think at our bank, the only AI that we're using, something behind the scenes in marketing and a lot to do with fraud detection. I mean, just fraud is off the charts, and I know we're utilizing it in that regard. I don't think we're using it yet in any sort of underwriting. We haven't implemented it.
Yeah, we're not there yet either with underwriting with AI yet, but I'm sure it's coming in the future.
Another question, we heard about insurance, and we're starting to see insurance flatten and sometimes even dropping, so it's a good time to shop your insurance and look to see what's out there. But have any of you had experience or been able to be a little more flexible with insurance on your properties?
You know, that's one of our biggest risks. I mean, the monetary policy, I think, is heading in the right direction as far as, increased lending, but what hampers us here is just increased commercial insurances, and we're not seeing it increase exponentially. We're not, maybe it's leveling off a little bit, but that's our biggest deterrent. We have some workarounds that we can get creative and mitigate, but not as many.
Yeah, for us, it's got to be a very, very rare, specialized situation where we're able to work with a customer where they say, hey, my wind and hail is $20,000, and I can't pay it, or it's not going to make my numbers work anymore. We obviously want the property covered. Our baseline is we require wind and hail, we require fire, we require flood if it's in a flood zone. Now, there are these very rare occasions where, okay, maybe your property's worth $1 million, you have a $100,000 loan, and no, we're not going to make you carry wind and hail possibly. It still takes an approval process for it, but there's a possibility, like in a scenario like that, where we wouldn't require it. Or maybe you're willing to pledge some cash to the loan in case there's some sort of wind event or fire event that takes place, although fire is a lot easier to afford. And so we've had instances where we've had customers pledge additional cash to a loan, and we will let them waive wind and hail. Again, very, very, very rare instances, but we will work with customers where it makes sense for both them and the bank.
On the residential side, there's no workaround. I mean, you're dealing with the agencies and the federal government. Either they have the required insurance or they don't, so there's not a whole lot of workaround there. I would also like to mention that condos in our market are becoming a significant problem with insurance. I've got a large background in the condo market and have for 30 years. I do a lot of business in that space. And what I'm seeing is a lot of the associations are being squeezed as well. So they're dropping their limits below the replacement costs significantly, or they're dropping wind and hail. And what it's doing is it's creating a situation where you can only have cash buyers in those units. So it shrinks your pool of available buyers. So just beware when you're writing contracts that you're looking at that on the front end and you don't spend thousands of dollars on inspections only to find out that there's no wind and hail insurance.
Yep. Quick kind of final question. imagine you're here October 2026, you're at the 16th annual economic forecast. What do you want to see what would you like to see? Any quick comments, Richard? We're going to hold you to this next year.
Yeah, no, I'd love to see interest rates at 100 basis point reduction, commercial insurance rates, actually coming down materially. New Orleans getting back on track with new mayor. Peace in the Middle East and, tariff control and, just
Should we
a
sing
little less
Kumbaya?
chaos, just a little more stability and quietness. That would be my hope for New Year's time.
Yeah, my hopeful again with Richard, insurance prices going down, more people doing business, attracting more business to not just New Orleans, but Louisiana, making sure that people can afford housing, making sure people can have a living wage is hopeful. A lot of people that we serve, people are still suffering, even with just insurance and other things because of the community that we do serve. So it still exists today, even though I do believe that times will be better. And within the next year, I'm just hopeful that, people can be able to live lives and, be happy and be able to buy groceries because the prices are still rising there, so that we have less homeless folk and things like that.
Insurance, knock on wood, we're almost to the hurricane season. Hopefully we'll get through with no hurricanes. It's been a great year for the country across the board with hurricanes hitting the United States. So if that continues, hopefully that leads to some additional stability in the insurance market, maybe some additional reductions. I know we've come down from our peaks on that, so hopefully we'll be talking more about that next year. Interest rates, hopefully they will be a little bit lower next year for the right reasons, not the wrong reasons. So I'm hopeful for that, which will hopefully spur some additional deals in the market. And then obviously the mayor, which we talked about in New Orleans, I think that's going to breathe some new life into the city and create some positive momentum that we'll be talking about next year.
Yeah, so none of us have a crystal ball. We can all talk about what we hope to see. If I'm sitting in this chair next year and you're asking me to recap where the year was, I'll give you my honest opinion of what I think the markets are going to do. I think you'll see residential rates in the upper fives. I would love to believe that we were going to be in the low to mid fives, but I think we're going to remain in the upper fives. We're going to see transactions in the greater New Orleans area creep up slightly, 3 to 5%. I think you will see that values on the residential side are going to slip a little bit this year. They haven't yet across the board, but I think we're going to see a 2 to 3% decrease in values. And what we're going to end up with on the residential market is a market that's about the same size and volume as it was this year because we're doing more transactions with slightly lower price points. I agree that having a new mayor who I believe can work with the city council will help move the city in the right direction. Our port is a gem. It continues to drive economic development. I think that continues and increases. Hospitality has stabilized. And I think if we learn anything here today, the word is that we've hit a stabilization period. Rates are stabilizing, insurance is stabilizing. Nobody really likes where we are for rates or insurance, but at least we're not going to our mailbox every month and getting punched in the mouth with an increase of insurance or seeing our mortgage rates go up every month. So markets like stability, and I think we've reached that point. I think things will improve a little bit next year, but the important thing to remember is they're not getting worse, so our overall market can improve.
Well, thanks. I always hear this panel, but always leave this forecast smarter than when I came in. And I think the one key thing I heard you guys say is importance about relationships and relationship building, working with your lender, getting the right information to them, getting timely to them, and stay informed, stay curious, ask the right questions, and we'll move forward. Optimistic about next year. So thank you so much.
Thanks, Bob.
Thanks, everybody.
All right, once again, ladies and gentlemen, give a very nice round of applause to our panel of esteemed presenters today. And now I'd like to welcome 2025 CID President, Mr. Michael Plauche, to deliver remarks on behalf of the Board of the Newmark Commercial Investment Division.
Good morning, ladies and gentlemen. Thank you all for being here today. I just wanted to take a moment. They've actually given me a 20-minute time slot here to talk to you all this afternoon, and I'm going to shorten that down to about 4 minutes. Okay? The timer's actually already started, Scott Graff, so it's now really at about 4 minutes and 15 seconds. Ladies and gentlemen, I just wanted to recognize our newly elected 2026 Commercial Investment Division Board of Directors. Please stand when your name is called to be recognized. Ron Petrone, CCIM with Coldwell Banker Commercial Tech. Maxwell Grosh with NAI Rampart. J.R. Rayford with Rayford Realty NOLA. Victoria Wagasback with Bobox Commercial. Jalandra Cole McNeil with the Culture Real Estate Brokerage. Please, let's give all of these individuals a round of applause. Thank you all for your willingness to dedicate your time, energy, and resources for the betterment of our commercial investment division of NOMAR. We look forward to continuing to lead the way as the premier commercial investment division for the state of Louisiana. Our entire board of directors would like to thank all of our valued industry partners and entire membership for entrusting us with the opportunity to bring the best educational and networking opportunities to you throughout the upcoming year. Good. I think I still got some time, guys. It looks like we're only at 2 minutes and 15 seconds left. Thank you all very much, and hope you all enjoy the rest of the afternoon.
Thank you, Michael Plauche. Ladies and gentlemen, at this time, we'd like to pause and take a moment to honor those who have made a lasting impact on the Metro New Orleans landscape and real estate community. From the Stevens Realty Group, please welcome Bob Stevens.
Our theme this year, Breaking Ground, the Emergence of a New Economy, resonated with the Planning Committee after the passing of some industry icons this year, Joe Canizero, Robert Merrick, and John Yemelos. In a few minutes, Rich Stone will say a few words about Robert Merrick. How many of you know where the Likes building was? Today, it's the Lowe's Hotel at 300 Poydras Street, an adaptive reuse property. Joe Canizero changed the skyline in New Orleans and Poydras Street. Aside from Likes on Poydras, he developed both 400 Poydras, the Texaco Center, and 909 Poydras, the LL&E Tower. From the names of these trophy properties, these developments happened in the once-upon-time era of oil and gas as a major sector of our local economy. I think most of us know where the Lakeway Complex is in Metairie, remaining today one of the area's premier mixed-use developments. Like Mr. Canizero, John Yemelos changed the Metairie CBD skyline. From Lakeway on a clear day allows one a view of the North Shore. Joe Canizero and John Yemelos were both bold, risk-taking developers from a different era. I knew and worked with both men. This was during a span of about 10 years from the mid-1980s to the mid-1990s. I was a representative of John Yemelos' largest commercial lender, and I was an employee of Joe Canizero's. During this period, we were actually experiencing an emerging economy. We were post-World's Fair. The oil and gas industry was undergoing major correction. Ronald Reagan had enacted tax laws impacting investment real estate, and real estate foreclosures were at an historic peak. The Resolution Trust Corporation was born with perhaps diversity in mind, allowing minority-controlled businesses to have the first bite at the apple in acquiring troubled real estate assets. We were developing city center properties, and adaptive reuse, tax abatement, and tax credits were becoming en vogue. Is there a reason for being considered an icon? We may all have an opinion about that, but both Mr. Canizero's and Yemelos' vision and fingerprints remain relevant today. Two quick takeaways from having known these men. They both knew their numbers on any project or deal they were working on. Mr. Canizero could calculate numbers in his head quicker than some people could keystroke the calculator. Both also understood the importance of relationships. They worked with governing authorities on plans and permits. They developed teams of architects, engineers, and contractors. They nurtured and negotiated with tenants and real estate agents. They had to have the trust of lenders. These are great lessons for everyone in the audience today. God bless these men for their accomplishments and their legacy. Thank you.
From NAI Rampart, please welcome Rich Stone.
Good morning, everyone. It's hard to sum up 39 years in 2 minutes, but I'm going to do my best. Bob Merrick's journey from modest roots to becoming a towering figure in our industry was nothing short of extraordinary. In 1965, while still attending Tulane University, Bob began working as an apprentice commercial appraiser under Max Durbus Sr., his first mentor in the industry. After mastering the basics, at the age of 29, he launched his own appraisal and brokerage company in New Orleans. With additional guidance from his second mentor, Heidel Brown out of Baton Rouge, Bob specialized in the brokerage of industrial properties along the Mississippi River corridor between New Orleans and Baton Rouge. He quickly gained a national reputation as a leading expert in that sector. After recognizing a growing demand for more functional industrial product in the area, Bob took the initiative to develop properties himself, ultimately becoming the region's largest industrial property developer. Then in 1986, during the worst economic downturn in the modern history of the city, he purchased Latter & Blum. That's where my journey with Bob began. And I had the incredible privilege of working for Bob at Latter & Blum for nearly 4 decades. That's more than a career, it's really a lifetime. Much of Bob's magic, aside from his tireless work ethic, was his uncanny ability to see opportunities that others missed, and then to have the gumption to make great things happen. He approached every plan like a chess master, anticipating 5 or 10 moves ahead. He didn't just react to circumstances, he shaped the future. He built Latter & Blum into a regional powerhouse with that same strategic mindset, turning vision into action and action into impact. Bob was not one to put on airs, but anyone who spent time with him learned very quickly that despite his old-school everyman persona, he was always the smartest guy in the room. Whether it was executives, politicians, CEOs, or any of the other people in nice suits who came from afar to see him, Bob had a way of commanding attention and becoming the focal point of any space he occupied. Through the years, there's a lot of life's lessons that I gleaned from Bob, and here's a few that stand out the most. Your word is your bond. Bob believed in the power of a handshake, and many of his most important deals began and ended that way. Put the time in, do your homework, and be prepared. Success doesn't come by accident. Throughout his life, Bob continuously grew his businesses and successfully pursued numerous impactful real estate brokerage and development opportunities. His deep understanding of our industry and his clear vision provided him with the confidence to take risks that others considered too bold. Have a heart. Bob's incredible philanthropy was well known and celebrated, but what you saw was really only part of the story. For years, Bob gave anonymously, quietly supporting charities and civic organizations that he believed could generate the greatest positive impact in the community. And he didn't just write checks, but also gave generously of his time to numerous charitable endeavors. Only later in life did he take a more public role, hoping to inspire others to follow his lead. But perhaps Bob's greatest lesson was to simply embrace life, which he did with energy, passion, and purpose, with great vigor right up to the very end. Bob was my boss, my mentor, and friend. I learned more from him than I can ever explain. And while our offices feel quieter now, his presence is still very much with us in the work we do, in the high bar he set, and the lives he changed. So Bob, thank you for your leadership, your loyalty, and for the good times. You're one of a kind, and it was one heck of a ride. Thank you.
Thank you, Rich. All right, a reminder to everyone, it's almost time to hand in your continuing education cards to those staff members and committee members that are stationed at each of the exits. This will be required to receive your CE hours for the first half of the day. Now, when you come back, those same members and staffs will be at the doors to give you another CE card to be filled out for the second half of the day, and that'll be right after lunch. Please be mindful of the time. Lunch will be starting back exactly at 1 p.m. with our very special keynote speaker. Thank you and enjoy lunch.